All right. Well, hey, Case, thank you so much. I really appreciate it. Hopefully, what you're seeing right now on your end is a big blue screen that says IUL training on it with my name and the date. Case, is that what you see?
Yes, that's correct.
Perfect, perfect. Well, great. As I said, Case, thank you for having us. It's a real pleasure for me to be here. Larry Jerkins, the regional vice president, he really wanted to be on the call today. Unfortunately, he can't make it. He had a memorial service to go to, death in the family, which obviously is it's just terrible. But I am happy to fill in. You won't get, what you're lacking in Larry's personality. What you'll get is some really good information and some good knowledge from me. I can't be as funny as Larry, but I do promise to deliver a lot of good information for you. Columbus Life and Next Vision, we've been partners for a long time now. For those of you who don't know, Columbus Life is over 100 years old, A-rated across the board, 96 Comdex. You don't have to worry about the security and financial history and financial strength of Columbus Life. For those of you who don't know, headquartered here in Cincinnati, Ohio. And before COVID and everything, we'd get up and see you guys every now and then up there in Minnesota or Minneapolis. So looking forward to doing that again, hopefully sooner rather than later. Get back out on the road and see some people. But what I've been charged with today is basically to deliver a couple things. One, we're going to talk about why index universal life in general is so popular or has become so popular, maybe over the last decade. And when I say that, I mean the sales growth in index universal life as an industry now, okay, has been exponential. And I'm using that word intentionally. It's been exponential growth, say over the last decade to 15 years. So we're going to talk about why index universal life has become popular and how the benefits really resonate with clients and what a lot of clients tend to like about index universal life. Then we'll pivot and talk about Columbus Life's Index Explorer Plus, which is a flagship policy here. We'll talk about how our IUL works and specifically talk about kind of what some of the benefits are from a high level standpoint. We're not going to get into any case design. That's going to be on a later call. We're going to start with the basics. Today is a basics training, an IUL 101, if you will. And really the whole goal is just to make you more knowledgeable about IUL, to make you more knowledgeable about Columbus Life's Index Explorer Plus policy, of course, so that at the end of the day, you become more comfortable and you become more confident when discussing index universal life with your clients and prospects. So with that being said, let's begin. Why index universal life? Why has index universal life become so popular? Why is there so much premium dollars? Why are there so many premium dollars going towards index universal life policies today? Well, the biggest reason is that you get a lot of upside potential, right? You can get a lot of upside participation when the markets are going well. When the markets are going good, your client's going to participate in a lot of those as it's related to cash value growth. The great thing with that is that generally speaking, you are going to miss out on the downside. Okay. For those of you who are familiar with traditional universal life, not guaranteed universal life, I'm talking about traditional universal life that once upon a time was pretty popular. The big difference between that traditional current assumption universal life and index universal life, really the biggest difference is how the interest rate credit is determined on that policy. With traditional universal life, the company just declared a rate, might be 3%, 4%, 3.5%, whatever the case may be. With index universal life, the credit's actually going to be determined by an underlying index, a stock market index, a bond index, whatever the case may be. With Columbus Life, we only use one index. It's the S&P 500. I'm assuming all of you have heard of the S&P 500. Most of your clients, if not all of your clients, will have heard of the S&P 500. That's going to make your job a little easier. What's great about this, we just talked about the downside protection, briefly talk about the downside protection offered by index universal life as it's related to market performance. Our IUL allocation options, that's where the premium's actually allocated inside the policy, they have a guarantee of either 0 or 1%. Now, a guarantee of 0% doesn't sound that great when you just say that out loud. However, think about recently some of the market corrections that have been experienced, say since 2000, right? 2007, the market was down, depending on how you measure it, at one point down 49%. Just last year, there was a mild correction that we experienced. It only lasted 3 months or so, but it was down about 35%, depending on how you measure it. Your client, if they own an index universal life policy, they have a guarantee of 0. So when the market is down that big, your client's not going to get a letter in the mail showing their cash values down 40%, 50%, 35%, whatever the case may be. They just get a zero that year. Now, a zero is not great, of course. It can be a little disheartening, but it's obviously much better in comparison to being down 30, 40, 50%. How can we do this? Well, the reason it works this way is because an index universal life policy is not actually invested into an index subaccount like how it might be on a variable universal life policy, if any of you are familiar with those, or at least have heard of them, of course. You're not directly invested in the underlying subaccount. Instead, we just use the index as a barometer or as a way to determine what the interest credit's going to be. This little chart here is just a way to talk about how index universal life, where it kind of fits on the risk spectrum, if you will. The biggest reason why index universal life is risk management. Risk management in protecting the client's cash value, risk management as far as keeping death benefits in force, because your client's not going to get a negative 30% one year in an index universal life policy. So along in the bottom axis there, you see the potential cash value accumulation. Obviously, the further you go out along that axis, the greater potential for cash value accumulation. But on the axis going up and down, the vertical axis, that represents the risk, or in other words, how volatile the policy can be. So the higher up you go on the vertical axis, the more risky it gets. The first thing we'll put on this spectrum is the traditional universal life policy. Obviously, you don't have much potential for cash accumulation due to a declared interest rate. Yet, you don't have as much risk either. Why? Because you just know what you're going to get every year. You're going to get that 3%, that 3.5%, that 4%, whatever the declared interest rate is by the company. You know you're not going to do any worse than that. So not a whole lot of risk. At the far other end of the spectrum is variable universal life policies. Now, variable universal life policies, once upon a time, were really popular. They were in vogue, but you don't see them as much now because of, a lot of people lost a lot of money when the market corrected. And they had all these, premium allocated to VUL policies, and then they lost a lot, and clients didn't like it, of course, and it caused policies to lapse. But right in the middle, right in this sweet spot is where index universal life sits. You have a lot of potential for cash value accumulation, clearly not as much as VUL, yet at the same time, it's not nearly as risky. Let's talk about how this downside protection actually works. Let's look at how how a hypothetical annual return may work with these three different policy types. The first of which is a variable universal life. You can see, and again, this is hypothetical, it just represents an annual rate of return. You can see the VUL went down in value that year. It's going to ride the market loss all the way down. Why? A VUL is directly allocated to sub-accounts. It's directly invested in the market. So when the market's down, your policy value is going to go down as well. Of course, the index universal life there showed up right along that blue bar. It's a zero. You're going to get a zero that year because you had a negative return in the market. You didn't lose money. You didn't gain anything either. And of course, the traditional universal life, in this example, when the market's down, it's actually going to come out ahead. Why? Because you get a guaranteed rate of return with that traditional UL. But let's look at what happens when you have the upside potential. Right? In this example, we have a hypothetical positive annual return. And you can see, again, the variable universal life is going to go all the way up to the bottom. Or all the way up to the bottom, forgive me, all the way up to the top. Why? Because you're directly invested in those sub-accounts. The IUL is going to do really well. You're going to participate in a lot of that upside. However, you're not going to get everything because of something called caps or participation rates or whatever your underlying allocation strategy is. In this example, it might just be a capped annual point-to-point, where you're going to participate in a lot of that upside, but you don't get everything because you exceeded the cap. And of course, to round out the conversation, clearly the traditional universal life policy lagged. Why? Because you only get that declared interest rate. You don't get anything above that. Okay. I don't care how good the market does. I don't care what the interest rate returns look like outside just the general financial marketplace. You're stuck at that traditional universal life declared interest rate. So you can see how the index universal life again sits right in the middle. What index universal life does is it reduces volatility over the long run. What you're looking at here are annual S&P 500 returns. But again, 1958 all the way through 2020, really, I think through the first half of the year, maybe the first quarter. And you can see the red bars are what clients don't want, right? You can see those losses, especially you look at the beginning of 2000. It was a rough start to the new century there. And then all the green bars, of course, represent the percentage increase in a given year. And of course, that's what clients like, right? They want to maximize the green bars and they want to minimize the red bars, right? Well, here's what's great about Index Universal Life. Thanks to the downside protection that we just briefly reviewed, right? We're going to go in a little bit more detail about how Columbus Life's allocation options work. But thanks to the allocation options, what IUL does is it takes away those red bars. It helps reduce those volatility. It helps reduce the volatility. Now, let me be clear. There are expenses, of course, with life insurance. And so when you have those 0% years, there are going to be expenses that still come out of the policy. So their cash value may go down in a year, but it's not going to go down nearly as much as when the market's down 20% or 30% like a VUL would. Now, of course, if we get rid of those red bars, what do we got to do? We have to give up some of the upside. So it's going to take away some of the potential upside that your client could experience as if they were directly invested in the market, as if they were directly invested into a VUL, if we want to make that comparison. So with that being said, let's talk about the Index Explorer Plus Universal Life. Again, this is the flagship policy here at Columbus Life. This is what we sell far away. This is what we sell the most of. And I want to start with just what are the basic mechanics of the Index Universal Life. Now, everyone on this call, I believe, has a life insurance license. So you've seen a chart, a flow chart, a graphic looking something similar to this, okay? At some point in your career, whether it was your life insurance license or just do some other sort of training material, the way it works is the client's going to pay their premium. It goes into the policy and helps contribute to the cash value growth. Of course, the other big arrow you see in the upper right-hand corner, those interest credits, right? And those interest credits going into the policy they're going to help the cash value grow as well. Of course, coming out of the bucket, coming out of the cash value, of course, on the lower right-hand side, you see the policy expenses. And then the lower left-hand corner, what you see are optional. They don't necessarily have to happen, but sometimes the client's interested in seeing them, are the distributions, right? These could be withdrawals, they could be loans, whatever the case may be. That's going to reduce the policy cash value. So high level, this is how it works. Client pays the premium. We're going to have interest credits along the way. We're also going to talk about something later on in the presentation that Columbus Life does that's a little bit different compared to some other companies out there with a guaranteed persistency bonus. We'll go into detail about that, but that's also going to help the cash value grow over time as well. These are the allocation options. Okay, we have 3 allocation options. Again, they all use the S&P 500, and of course, we have a fixed account. Now, the fixed account's paying 4.2%. It's a very strong fixed account. It's very competitive. I'm not going to sit here and tell you it's the best. I'm not going to sit here and tell you it's the best in the industry, but I do know you'd be hard pressed. You would be hard pressed to find a fixed account paying 4.2% with the quality carrier that Columbus Life is, with a 96 Convex rating, A-rated across the board, over 100 years old, with a tremendous Index Universal Life policy offering in general, paying a 4.2%. If your client wants some more guarantees associated with the policy, you can always allocate a portion of the client's premium to that 4.2% fixed account. We have a capped annual point-to-point. Right now, that one in green that you're seeing, that is far and away the most popular. That is the most popular allocation option right now, because the capped annual point-to-point has an 11% cap. Again, I'm not going to sit here and say it's the best in the industry, but it's very, very good. You'll be hard-pressed to find a better cap rate out there. The next 2, we're not going to spend nearly as much time on today because they're not as popular due to pricing pressures, but we do have an uncapped annual point-to-point with spread, and we also have an uncapped monthly averaging index account. Once upon a time, this account you see in purple, the spread account, that was probably our most popular account because the returns were phenomenal. Right now, again, due to pricing pressures, the one you really want to be aware of is the green one, the capped annual point-to-point, again with an 11% cap. Let's begin with, what do we mean by annual point-to-point? Okay, forget about everything else. All of our allocation options are annual credits, right? So they're going to look at when your index segment starts. In this example, you can see it started in January. And then we're going to look at how it starts next, or we're going to look at how it concludes next January. So what you're seeing here is the blue bar across the top here. That's a hypothetical annual index return through the course of the year. You can see the index value changing over time. The fact that it goes up and down throughout the course of the year doesn't really matter. What matters is where the index begins and where it ends. And what we're going to do is measure that percentage increase over time. That's what we mean by annual point-to-point. So let's look at how this looks with a capped annual point-to-point. Again, this is our most popular strategy. And what you're seeing here is that 11% cap. That's the dashed orange line across the screen, while the blue line represents the hypothetical index percentage gain over the course of the year. Now you can see, again, we're going January to January. You can see that generally speaking, over the course of the year, the market was up, yet there were some hiccups along the way. You can see in May, the index value was up a lot, and then it came down, and then it went back up and back down. But then you can see where it ended up. We had a percentage gain of approximately 8-9%. Again, it's all hypothetical. It's just to help illustrate a point. It doesn't matter that the index was up about 20% in May, and it doesn't matter that in September it was down to only like a 4% gain. It matters where it ends at the end of the year. And so you can see that in this example, the market actually ended in this annual window, okay, because we're measuring point to point. We're measuring point to point. The market might have been up hypothetically about 9%. Had the market been up above the cap, you would have been capped at that 11%. Let's go through a quick example. This is the chart that you grab, the graph, I should say, that you saw previously, kind of illustrates the visual. Let's do the math here real quick and look at how this might operate. So right now we have an assumed cap rate of 11%. Our beginning index value was 1,200, and our ending index value at the end of the year was 1,377. What we're going to do is determine what the percentage gain was through the course of the year using these values. In order to do that, we're going to subtract 1,200 from 1,377 and divide it by 1,200 to get a percentage, right? That's going to give us 0.1475. We're going to turn that into a percentage by multiplying by 100. That's 14.75. Okay, I went through that math quickly, but basically we're just kind of finding the percentage increase. In this example, because 14.75 is greater than an 11%, which is the cap, the client's interest credit that year is going to equal 11% on that allocation segment. If the market was, let's say the percentage gain was only 6.5%, the client gets 6.5. Why? Because 6.5% is less than the cap. The client's going to get the full 6.5%. What if the market was down 25%? If the market's down 25%, while that's bad, the good news is your client's not going to be down negative 25. They're going to get a 0. Let's talk about the annual point-to-point with spread. Our spread's a little different. I'm going to go through this quickly because right now the pricing on it's not attractive, as I said. But I do want you to have a basic idea of how this operates because you're going to see this in the marketing material. If a client asks, you need to be prepared to be able to discuss it. The way it works is you earn a threshold rate, and your client always starts by earning the threshold rate up to that given percentage. Then the spread is taken out of the middle. So everything that you see shaded out of the bar there, the client's not going to participate in. Here's the good news. Anything above that spread is uncapped. So if the market's up 35%, you're going to participate in a lot of that. You know, you compare that to having an uncapped option. Compare that to the capped annual point-to-point that we just went through. You have the opportunity to really hit some home runs with this uncapped annual point-to-point. Let's go through the math example here, and you might see how it works. So what we're assuming here is we have an assumed threshold rate of 5%. Again, the client's going to participate in that threshold rate before anything else happens. In this example, we're assuming the threshold rate's 5%. We're also assuming our spread rate's 5%. Remember, the spread rate's the part that the client will not participate in. Again, it's still an annual point-to-point. Our beginning index value hypothetically was 1,200. Our ending index value hypothetically was 1,377. We're going to do the same thing that we did before to figure out the percentage gain. In this example, it's still 14.75%, but now we must subtract the 5% spread, which is going to give us a 9.75 interest credit for the client in that given year. Okay, we're going to find the percentage gain, and then we're going to take out the spread. That's basically how it works. Now let's look at this last example, the uncapped monthly averaging. This is the one that has the most moving parts. It's probably the most convoluted. It also, just long-term performance doesn't look as good because of, it just doesn't work that well compared to the other allocation options. But for those clients who, they like the idea of being able to participate in monthly gains, it's there. In a volatile market, you could potentially do better in the monthly average account. But what it's going to do is it's going to look at the index value over each month and take a month anniversary look, if you will, and it's going to average those out. So you can see the different hypothetical values each month. In January, it starts at 1,200, then went to 1,288, then 1,305, then back down to 1,190. What it's going to do is average all those out over the course of the year, and it's going to measure the percentage increase from the beginning value above the monthly average. Doesn't matter that the market ended up at the 1377, you're only going to get the percent increase, of course, across the monthly average. The other thing to be aware of with this strategy is something called a participation rate. And basically, it's just a rate set by the carrier to determine how much of the interest gain is credited. Let's go through an example to show you how participation rate works. So in the previous example, our 12-month average equaled 1,300. Again, it doesn't matter that the index was actually up 1,377. It only matters what the 12-month average was. And also in this example, we're assuming the participation rate was 50%. So just like in the other examples, we have to find a percentage increase. In this example, was 8.33. From there, we have to take the 8.33 and multiply it by 0.5. Why? Because the participation rate's 50%. So we have an interest credit in this example of 4.17. Okay. Why? We had an 8.33 monthly average, but then we only participate in half of it because that's the participation rate, giving us an interest credit of 4.17. High level, that's how the allocation options work. How else does Columbus Life help your client? How else do they help your client grow cash value? Well, it's something that I'm happy to talk about. It's a guaranteed, contractually guaranteed persistency bonus that begins in policy year 11. How much the persistency bonus is credited will depend on the issue age. Obviously, for younger ages, 29 and younger, it's 25 basis points. For issue ages 30 to 79, it's 50 basis points. Okay. What's great about this is the fact that, we're rewarding your client for keeping the policy in force. Especially for a client who might be 35, the policy could be in force for another 50 years. The fact that they're getting this guaranteed bonus credit each and every year could make a really big difference on their long-term cash value performance. Let's briefly talk about expenses. These expenses, they're not, we do have an optional expense report you can include, but I want to talk about these quickly. You do have a premium expense charge of 6%, a cost per thousand. That's only assessed for the first 10 years. Of course, you also have cost of insurance, will depend on the age and gender of the client, as well as underwriting rate class. And there's a $4 monthly policy fee. If you want a detailed breakdown of expenses, Sandy is your internal wholesaler, but anyone on the Columbus Life sales desk can help you run illustrations. We can add an expense ledger if you'd like to see how expenses work on the actual illustration. Of course, I'd be remiss if I didn't talk about the accelerated death benefit rider. It's included standard on the IUL, just like it is with the Voyager GUL. The Life Plus accelerated death benefit rider. This is the chronic illness, terminal illness, and specified medical condition. I do want to talk briefly about how the chronic illness rider works. You probably remember we do have two options as far as how it can be paid out. It's a lump sum payment or a periodic payment. The periodic payment is the lesser of $1 million or 50% of the death benefit. That's your maximum amount. And then you're going to divide that by anywhere from 3 to 10 years. That's how Columbus Life defines periodic payments. So quick example. Let's say you had $1 million death benefit, right? So in this example, it's the lesser of $1 million or 50% of the death benefit. That would be $500,000, of course. That's $500,000. And let's say they want the payout year to be 5 years. Well, easy math. 500,000 divided by 5, the client's going to get $100,000 in annual benefit for 5 years, and then the benefit will be exhausted. Of course, lump sum, this is where the cash surrender value becomes important, and this is where the IUL can really shine, is because it's the cash surrender value plus the lesser amount of $250,000 or 40% of the net amount at risk. Don't let anyone tell you. There's a lot of people, there's some misinformation out there that Columbus Life's chronic illness rider, you can only get $250,000, and that's wrong. That's summarily wrong. It's the cash surrender value plus $250,000 or 40% of the net amount of risk. That's the maximum advance amount. That chronic illness, those living benefits are so vital to talk about with your clients. And Columbus Life Chronic Illness Rider, the standard version, is very competitive with what's out there in the marketplace. So high level, that's how the IUL at Columbus Life works. I think in future calls, Case and I would discuss, we're going to get into some actual policy design later on and how the illustrations can look and all that kind of stuff later. For now, we just want to give you an idea of why Index Universal Life, what some of the benefits are, how the downside protection works, and of course, how Columbus Life's policy works. Let's talk about some of the benefits to IUL now. Well, obviously, there's a lot of tax benefits that can be used. Of course, you have the tax-deferred cash value accumulation. You have the income tax-free death benefit, of course, and then potential for cash-free, tax-free distributions. That's, of course, assuming the policy is not a MEC, of course. I'm not going to go into MECs today, but we want to avoid MECs, generally speaking. So the client, if they so choose, they can take distributions out of the policy, income tax-free. Of course, another big benefit is what we spent a lot of time on today is the risk management component, where you have a lot less volatility compared to other things out there in the marketplace. Yet you get all this upside potential thanks to the Index Universal Life, thanks to the index nature. But yet we've limited that downside. When the market's down 30%, your client's not going to get a negative 30, and that's what's going to keep this policy in force. You're not directly invested into any underlying security. You are not invested in any underlying index. You just have guaranteed floors, okay? The other thing that's great about IUL is the flexibility. You have a lot of different designs, a lot of different sales concepts that can be used. You can design a policy so that we're going to accumulate as much cash as fast as possible. There's a lot of policies out there that we can talk about maximizing the death benefit. We can do different things like endowment solves, all kinds of different things. I'm not going to spend too much time on this today because we're going to do subsequent calls where we can talk about the different design applications. But just know something that's really nice about IUL is the flexibility that's inherent in this. The last thing I want to talk about briefly is the Expedition SIUL. And I don't want to muddy the waters too much, excuse me, but you should know that Columbus Life has a second to die IUL. There aren't many carriers out there that have survivor index universal life policies. This is important to know. If you have a client that wants to maximize the amount of money that's going to go to their kids, maximize the amount of money that's going to go to their grandkids, or they just might be a little older in general, you'll find that it might be actually cheaper and more beneficial to use this policy instead of the regular index universal life. You can see the issue age is there, 20 to 79, minimum face amount of 100,000. What's easy about this is that it's the same allocation options that we just went over. On the IUL, they apply the Expedition as well. You have the guaranteed persistency bonus, 50 basis points for all ages, beginning policy year 11. Again, it's contractually guaranteed. Where this really fits in compared to the regular IUL, the flagship policy, is that you can use it for legacy purposes. You can use it to max fund policies if they want to accumulate as much cash as possible. And it's something that's in there too that you should know about is the idea of potentially, it's not guaranteed, but potentially for uninsurable sales. Now think about this. Because it's survivor index universal life, as long as one person you're talking to can get life insurance on their own from a medical standpoint, if the other person that you're talking to is declined for medical reasons and underwriting, we may be able to include them on the policy. This is very valuable. If you spoke to a client, 6 months ago, a year ago, whatever, who wanted to buy life insurance to give money to their kids or their grandkids, well, you may be able to go back to them and say, hey, if we can put your wife or your husband or someone on this policy, you might be able to include them on this policy and get them covered. Obviously, survivor insurance is a wonderful thing to create a legacy. And then, of course, the last thing to be aware of, if the beneficiary is the next generation, a kid or grandkid, this won't work if the intended generation or the intended spouse is the same, or the intended beneficiary is the same generation, such as a spouse. But generally, premium may be less expensive by using the SIUL compared to index universal life. Okay, I don't want to muddy the waters. We're not going to go too much into SIUL today. However, you should know that this policy exists. At this point, I'm happy to answer any questions, but of course, Sandy's a wonderful resource, as well as Larry. You can see the sales desk number there if you have further questions about IUL, if you have further questions about Columbus Life. The number is 1-800-677-9696, option 4, or of course, email the sales desk, clsalesdesk@columbuslife.com. And again, Sandy is your internal. She loves working with Next Vision. So please reach out to her. She's on vacation right now. Otherwise, she probably would have done this call. And I think she'll be back for next week's call. But Case, at this point, if there are some questions, I'm happy to answer them, or I can turn the call back over to you.
Okay, guys. Yes. If you have any questions, feel free to ask. That was a great training from Andy. A lot of great information is there. And it's perfect for our 101 IUL master class. So thank you very much, Andy. Thanks for your time.
Hey, it's no problem. Thank you. Thanks for having me on today. We always appreciate the opportunity to work with Next Vision. We appreciate the partnership.
Sure. Guys, we have a few more minutes. If you have any questions pertaining to Columbus Live or just, IUL in general, Andy is the expert here. So if you have any questions, feel free to ask. Okay, if you don't have any questions, I'm also recording this training, so I'll be emailing them to you guys. And next week, we're going to continue the training with Columbus Live. We're going to do a lot of illustrations and case designs. If you have a prospect or if you like to see certain designs, please prepare that. And I'm sure Sandy or Larry would be happy to run some illustrations for you. Andy, you're not going to be here next week, right?
At this point, I'm not sure. I got to talk to Larry and Sandy. So I can't answer that right now. Sorry.
All right. Yep. No problem. No problem. And yes, next week we'll do some illustrations, case designs. We'll talk about taking loans out, building up that cash value for retirement planning, for college funding, all these great concepts and strategies for you to use. So make sure don't miss out next week, same time, 3 p.m. Central Time. I believe you don't need to re-register again. You register once and you should be allowed to attend all the trainings for the next 3 or 4 weeks here. All right, guys, if no further questions, I'll see you guys next week, next Wednesday at 3 p.m. Central Time. Thank you very much. And thank you, Andy. Thanks for your time and for the great training.
Hey, it's no problem. Thank you. Have a good day.
Thank you very much.